Sure.
Please switch off your volumes. We start today's market talk. Investing demands a rational approach, free of emotional biases and attachments. You see, most of the time I've seen, we think like our investments are like Sachin Tendulkar. They are infallible. They are, but the point is, they are subject to market dynamics, economic shifts, or our our selection of stocks may be just plain wrong. So don't fall in love with investment. It doesn't matter if your thesis has got flaws or there is wrong. You can always correct it. Okay, the setup as I see it, uh, we all know Jerome Powell's soothing remarks post the FOMC meeting on Wednesday has led to a huge rally in equities, in bonds, and even in gold. Uh, Fed has managed to pull off a near impossible soft landing while getting inflation down amid some of the worst conditions possible. So, what Mr. Powell has done, he has beaten inflation and recession. So, for the first time, the rates are going to come down without a recession. So, from here on, where everything good is now getting priced in, it is better to add quality stocks only on every day and participate in the long-term bull market. So the rate cycle, once there is a rate cuts, it is good for cyclicals. Uh, and what Powell said was that rate cuts will happen before inflation is close to 2%. So that means people are already factoring in 4 or 5 rate cuts next year, and maybe the first rate cut by March. So post that, RBI will also cut rates, and which will give momentum to cyclicals like real estate and autos, etc. Now coming to India, robust capital expenditure revival cycle is expected to be the prevailing investment theme shaping the trajectory of Indian equities in 2024. So there are long-term investment opportunities nowadays in defense, infra, railways, real estate, etc. In addition, financial services and healthcare offers immense opportunities, and India will gain from shift in global trade and commerce. So coming to few stocks, Protean, which had an IPO recently, it's a pioneer in e-governance solutions and digital public infrastructure. It's a unique play on the rising digital adoption in India. It has three verticals which contribute to its revenues: tax services, that is that is your PAN card; NPS, and identity service, that is Aadhaar. So year on year, it had 33% revenue growth, 25% EBITDA growth, and 28% PAT growth. It is getting into ONDC, cloud, and info security services. 65% of the revenues are from B2C only. So it's a misnomer to feel that it is dependent on government revenues, because it is getting direct revenues from customer every time you do a authentication or anything like that, or make a new Aadhaar card or PAN card or anything else. It is at 35 times P to FY25 earnings, which is reasonable. And I think the lock-in for anchor investors is likely to get open maybe this week or next week or so. That would be a good opportunity in case there is a correction. Rising insurance penetration, higher per capita income, preference for quality healthcare are favorable for Max Healthcare. Max will benefit from capacity expansion. They had 13% year-on-year growth in average revenue per occupied bed, which is now roughly around 74,600 rupees. International patients' revenue is growing at 25%, and it is around 9% of revenue mix. They have done a brownfield expansion of Max Shalimar Bagh, And they are also into Max Labs. Please switch off your volumes, please. Max Labs, which is 30% of year-on-year growth. So that is diagnostics is also doing well. Their Dwarka hospital with 300 beds is expected to be operating in Q4 FY24, that is next quarter. And if you see the EPS around 18 for FY25, they are at around 35 to 40 times P, which is slightly on the expensive side. So buy it on dips. It's a good stock with regular revenue flows. Uh, Now, the stock which was in news was PI Industries because of pyroxasulfone, uh, which has a huge market demand, and it has a patent protection for PI Industries for the next few years. So, as per the management, it would have limited impact on PI Industries' growth story. But PI Industries saw a steep price correction as competition fairs got set in. Plus, one of its key clients, Kumiai Chemicals from Japan, issued a weak outlook for FY25, but PI's management has reaffirmed their FY24 guidance. The problem started when China's Rainbow Agro announced a capacity to manufacture pyroxasulfone. It's a herbicide with huge demand across the world. It contributes 55 to 60% of PI's exports. Now, they had a patent in few small markets. No, pyroxasulfone has gone off patent in few small markets like India and Australia, but its active ingredients is patent protected in US and Latin America till 2025. So, PI's management has confirmed its guidance of 18 to 20% top line growth for next 1 or 2 years and 24 to 25% EBITDA margins. So, and next few quarters also, because it is patent protected, you will not see any impact for next few quarters. So the impact, even if it has to be felt, will be felt after 1 or 2 years only. Though current high dependence on one molecule is expected to come down as PI continues to launch and register other innovative molecules. PI's pharma business also has potential, and it is growing that business to add new levers for future growth. Now, if you see FY25 expected EPS is 120, so the PE has come down to now around 28 times, and it normally trades at around 40p because of the growth it offers. Though pyroxasulfone is a 60 to 70 million dollar market with a huge potential for upside. So we have to keep watching this space. So this is the chart of PI Industries. So if you see, uh, there was a vertical drop after that news, and it was looking good, and it crossed 3,800 level, but then it has come down to 3,300, 3,400 level. But these levels and around 3,000, if these levels break, are a decent level to accumulate. Now you can see it has fallen with huge volumes also. So that is the only point of worry. So just keep a watch on this. And I think it's an accumulate on dip stock. And you can't say, let's see the next quarter's results or after that, because uh, that uh, that uh, uh, the patent is protected for next 1 or 2 years. Now let's talk about certain technical aspects. US 10-year yields. This is a daily chart. It has come down from around 5% in October end, to now below 4%. So it has fallen and has come down to the 61.8% retracement zone, which was expected now. So next leg of fall will take it down to this 3.6 levels, which is expected moment there would be another positive commentary of just a 25 basis point. So you can just reduce 25 point this, it will come to these 6.3.6 levels. So moment you reduce 25 basis point from here, it will reach those levels or maybe more. So uh, that is the thing. The Brent crude prices, I had indicated that this 70 is the support level, and this is the level at which generally it takes support. So watch for this level. Last time I had indicated this. Now this is below all its 2050 EMAs because there is a lack of demand expected all across the world. So there is going to be excess supply. So that's why crude is also correcting. Dollar index, because of the Fed's commentary, is correcting, has come down to 102 odd levels, and it should correct more. So watch for these 100 odd levels. Once that breaches, it's likely to go down, and that is the reason why the other currencies are strengthening. And the another reason for the strength in, oh sorry, the lack of strength in US dollar was the strength in euro because they are not talking about rate cuts till now. Gold, that rally has stopped. It went up to 2070 level where it is generally makes a top and then has retreated from there. So let's see. Right now it is above the 20 EMA. So let's see where it goes from here. But in my view, it is not likely to go up because gold is a hedge on uncertainty, and that right now I don't think there is any uncertainty as such. Dow Jones, it has taken support as I brought out over the rising trend line, long-term rising trend line, and also has broken off from the declining trend line, and now it has had seven green weekly candles. So, and it has taken all the world markets down, and it is expected to go to fresh highs now. This is India's 10-year yield. It is corrected, and it had a major correction on Friday itself. So it has come down to 7.1 because of they are now factoring in rate cuts in India also. Maybe another by March or something, we will also have a 25 basis point rate cut. Nifty 50 index. So if you see this is a weekly chart. If you see the rising trend line from here, uh, from last year, this trend line is culminates to around 22,000. So that should be the first target for in this rise. And similar to Dow Jones, where they had seven green candles, weekly green candles, we have also had seven green weekly candles, duly supported. The first lot was because of the election results, and the second lot is basically uh, because of the Powell's statement on rate cuts. This is the Nifty 50 daily chart. So if you see, it went up and then it was petering out and had a negative day, and then it made that dragonfly doji which I had brought out, and then last 2 days it has again had uh, gap ups and is going up. Right now it is trading much above the all the moving averages, and I think the Nifty PCR is above 1.45, so it is kind of overbought right now. So it should it should correct whenever it will correct, but it is likely to correct. Now this is the hourly chart which I wanted to highlight. As I said, that 20 hour and the 40 hour is the basic support in the uh, short term. So the 20 hour moving average is at 21,200 and 40 hour is at 21,075, and these are rising averages. So as the Nifty keeps going up, these averages will also keep rising. So these should provide support. And if you see over a period of last few days, these averages, especially the 40-hour average, has held out. It dipped below for some time, but then it bounced back very nicely from there, the 40-hour average. So just keep these two averages in mind. The gaps which have happened every day now will provide cushion on any pullback. Now, Nifty's rise is supported because Reliance, it has broken above its 20 EMA, and above the declining trend line. So it has had a small kind of a breakout, but it is still has got long way to go. And in case Nifty has to go up, and rest of the sectors have run up already, and this is still far away from its all-time high. So this should be the one which should be leading the rally next. And you can go long in this with the 20 EMA as a stop loss. The other stock which is doing well is Eicher. Again, if you see, there is a rising trend line, and it is above that. It is above the its 20 EMA and all other averages. And with the interest in these bikes and high-end consumption and new launch of bikes, this is one more stock which is leading the Nifty up. Nifty Bank, if you see the weekly chart, it has broken out to all-time high, and it has had three now. Once it broke the 20 EMA, it has had three weekly positive strong green candles, and is likely to go to its target of around 50,000, which everybody is talking about. And it was a laggard earlier. It was going behind Nifty, but it is now, it seems that it is going to lead the Nifty. And this is a daily chart. If you see, it has broken above its all-time high, and it's now heading up. And I think this 20 EMA is broken above the 50 EMA, and it is a rising thing. So it should also keep going up. With uh, SBI and ICICI Bank have hit all-time high, and other heavyweights like Kotak and HDFC Bank have still to hit the all-time high. So they should outperform now. This is HDFC Bank. So if you see, it was in a declining trend line. It went below its 200 DMA also, and now it is broken above that. And let's see if it's able to cross this 1670 level, which is the first resistance, and then the 1700 level, and then go up, because that should be taking it to all-time high. But Nifty Bank is got which where there is unfinished business right now. So let's see if these heavyweights are able to perform. ICICI Bank has reached its uptrending trend line. Now, if it breaks out from there, then that will be a breakout. It went to its all-time high now. So this is the one which has to be watched. It bounced back from these 920 odd levels, and now it is looking up. This is the PSU Bank Index. This is a weekly chart. Again, there is a rising trend line. It has broken out from there on weekly charts. So it should do well. And this is basically because SBI has broken out to its all-time high, went to around 650 odd. And again, SBI has also broken out. It's similar chart to ICICI Bank and all that. So it should do well from here. Another stronger index is the Nifty Public Sector Enterprises Index. This is a weekly chart. So if you see, it is in a constant uptrend, but this uptrend has got magnified in the last uh, these 7 weeks. So if you see from here, these seven big green candles have taken it above the moving averages very quickly, and reinforced with the continuity of the government. So the policy should continue. But mostly now these stocks have realized their values. All the PSE index stocks have realized their values. So now, if they will move with the market, like 15-20% growth in a year. They will also have as the economy or the GDP grows. This is NTPC. It went to its uh, it went to its all-time high now to 300. If some of you will remember, I had recommended it at around 170 now, and see the rally after that. It has never broken through above below its 50 EMA. So the place to buy it is closer to moving averages, not away from the moving averages. This is BDL, Bharat Dynamics. defense stock. If you see the weekly chart, it made a low in October, and then it has risen now, and I think it should go to 1500 in this up move. And volumes are slightly better than the normal average volumes, so it should do well. Uh, the index which has really broken out the last 2 days is the Nifty IT index. So it should test its all-time high and then maybe head from 38 after crosses 38,000 to around 40,000, and it is now clearly above the upper trend line where it was stuck for a long time now. So this is the index which is in up move. This is basically due to Infosys, which is still away from the its all-time high. So it has got some distance to go, but it has broken through that declining trend line. So now I think these once the 20 EMA breaks above the 50 EMA, then it should also see some more up move. It is the midcap IT which is strong. So one of them is Coforge. It's a weekly chart. Coforge has gone above the its all-time high, and now it has broken above that. So watch out for these midcap IT stocks and Coforge and others like them. They are the ones which are expected to outperform now. This is the Nifty Midcap Index. Same, similar charts. The weekly chart, 7 strong weeks of green performance, and the uptrend has started from March onwards. And this is likely to continue because of the domestic money which is coming into this sector. So all these constituents of Nifty Midcaps are expected to do well because of this SIP money and so much of interest in the market now. This is a small cap index, again similar chart. It was trying to halt, but again now it has taken off. And first, mostly generally what happens is first large caps move, and then once the large caps start consolidating, then the small caps and mid caps move. So maybe they may halt for 1 or 2 weeks, but they will also follow up. So generally talking about technical aspects, instead of getting biased with your opinions, we have to just see what the market is saying about itself. What is market talking about itself? As market has all the news and views tied into it with emotions of people mixed in. So buy all the dips till the time it works and remain invested, or till the time money making becomes too easy. So that is the signal where stocks start moving, flying all over the place. That is the time that market is becoming expensive. Otherwise, till then, if the buying the dip is working, then remain invested and keep adding on to your investment. And even if you have to make a mistake, please make it in the direction of the trend, and the trend is uptrend now. So don't try to short this market. That is my only point. Now, some of the stocks which I will cover today. First is Thermax. It's an interesting stock. It is developing products and services that will help reduce the carbon footprint for its industrial users across bioenergy and renewables. It has now 14 bio CNG plants under operation and construction. It has received 5 bio CNG plant orders for 500 crore in December 23. It is looking to enter into electrolyzer manufacturing, EPC, and hydrogen production. So that is another good point. It has developed a pilot project for coal gasification and is looking to scale up the solution to 200 tons per day to 500 tons per day in coming years. So again, coal gasification is one of the projects which would be in the focus maybe after a year or so. Then this THVAC, which is basically Thermax heating, ventilation, and air conditioning, is a solution to cool any bus using heat of exhaust gases. So it can retrofit this solution to trucks also. So again, this should be in focus. It is offering its industrial customers comprehensive offerings, captive renewable power under a subsidiary, and supply steam to customers under long-term contract, again under a subsidiary. It has already installed 80 megawatt peak. P is peak at end March 23 and looking to raise the capacity to 300 megawatt uh, peak capacity. It has limited competition in each of these new segments, and all the new products are looking quite promising. However, the revenue potential is difficult to ascertain at this stage because order flow still has to come and the incentives have to still flow in from the government for these. Now, this is its P&L. So if you see, this is in millions. So roughly 8,000 crores the revenue, and EBITDA margin of 7.4%, and net profit of around 450 crores, EPS of around 38, PE around 72. But FY25, it is expected to have around uh, 11,000 crore, 11,600 odd crores of revenue, with EBITDA likely to improve to 8.2 and EPS of around 60-61 here. And then PE should come down to around 44-45, and ROC and ROE, etc., are expected to be improving. It through its subsidiaries, it offers a range of products and services across bioenergy and renewables. It is entering into coal gasification and electric energy solutions, including electric pumps. Expect it to post around 14% CAGR growth in revenue of strong order book. It has a order book around 10,000 crore, which is roughly, if you see FY24, equal to around 1.1 times FY24 revenue. So there is a revenue visibility, and with it getting into decent sectors and decent projects, so it should do well from here. So if you see, the order inflows is diversified across segments for Thermax. So it is into all these segments: metals, refinery, pharma, paper and pulp, fertilizers and agro, cement, power, engineering, chemical, sugar, distillery, food and beverages. Uh, Expect order inflow to start growing from FY25. This is in billions, so roughly FY25 it is expected to get around 11,700 crores of orders, and in FY26 it is expected to get 13,600 crores of orders. So let's see once it happens. But presently the order book is around uh, 10,000 crores, so that's okay. Free cash flow is also improving, so the debt will not be there. So this is the operating cash flows, and this is the free cash flow. So free cash flows are improving now, and once they've improved, then they can do the capex using these free cash flow, and return ratios are also improving, so which should help the margins. This is the Thermax technical chart. It went down, tested its 200 EMA to around uh, 2580, and then bounced back from there. And I think this order win has taken it above the 50 EMA. So watch this. Right now, I feel it is fully priced. So on this is a stock which is buy on dips on closer to its averages, because once it gets big orders or big this thing, then only there would be a kind of a breakout or something like that. But you can easily hold this stock for long term. The other stock which was in news is Subros. It has the highest market share in thermal products, with market share of 42% in personal vehicles and 51% in truck segment. Company is targeting a market share of 45% in PVs and 55% in trucks in the long term. Maruti and Toyota account for 84% of the revenues. Mandatory installation of AC in N2 and N3 CV segment. N2 and N3 are related to load factor in commercial vehicle segment, will boost revenue and help improve margins. It is also catering to railways, commercial vehicles, tractor, home AC segment, but I think they are not focusing on home AC segment because of lower margins. It has recently won tenders from railways for supply and commissioning of coach roof mounted ACs amounting to rupees 25 crores. ROC is around 14% based on first half FY24 performance, which is helped due to material cost reduction, capex optimization, and increase in operational efficiency, has improved the ROC. It has set up three centers for R&D, application engineering, and tooling development. So if you see, it had a if you see here, it was constantly in double-digit operating margins. Then in 2021 and 22 and 23, it has a dip in its margins. Now the margins are improving, and which led to a dip in its profits and EPS also. So watch out for this margins for this. It is targeting EBITDA margins of greater than 10%, and it says that it will outpace the industry growth by 2 to 3%. 77% of the revenue are from personal vehicle segment and basically AC products with two major customers, as I brought out, Maruti and Toyota. Uh, what is going to happen is it is moving to rationalize tax rate from 1st April 24, which will improve the EPS. So that will be another boost to the EPS. Where they will reduce their tax rate. Uh, they are coming up with products for both all segments. That is passenger, truck, bus, railways, refrigerant, and tractors. So then it should help improve their revenues, visibility, and all that. And so this is how they are targeting. Greater than 9%. They are targeting 10% now. So it is on a improvement path, the EBITDA. So this will have a big impact. And ROC is, if you see, are also improving. And now it is reaching 14 odd percent. So it should go up more. So that will again help in profits. This is a chart. As I have seen mostly, this stock on, this is news based. So on every news, it spikes up, goes to these 500 levels. Then it corrects, comes down to by 100 odd rupees, comes down closer to the 200 EMA, and then again there is a news and it spikes up because you have to see the execution. So if you have to get this stock, get it closer to the any moving average, and because you have to watch this performance. This is for a long term hold, or it's a news dependent stock as on date, because if it is the point is, if the already is having nearly 41-45% market share, so how much can it grow the market share, because they are also saying it will grow by 2-3% only, even if they will get orders, because the rest all competition will also come into the same space from other players in the similar AC market. So the last stock today is Ugro Capital. It's a tech-enabled NBFC with exclusive lending focus on MSME segment. Technological capabilities, data analytics, and template-based underwriting has ensured faster growth without diluting credit filters. Within MSME, the company is focused on lending to healthcare, education, chemicals, food processing, FMCG, hospitality, electrical equipment and components, auto components, and light engineering segment. It offers diverse products of secured LAP, that is loan against property, affordable loan against property, unsecured business loans, machinery loans, and supply chain financing to MSMEs. The average interest yield vary from 13 to 14%. It also has partnership and alliance channel where it is joint lending with NBFCs and fintech. So the liability doesn't comes in its book, or it's on its balance sheet. Co-lending is mutually beneficial as it allows banks to uh, meet their priority sector lending targets, because banks have to lend to MSMEs and all those issues, if they're not able to locate them or they're not able to analyze them. So these NBA, so these fintechs like Ugro Capital analyze their credit rating and give the solution. So they do a joint lending. While large NBFCs gain from the first loss default guarantee arrangement, now here what happens in FLDG is fintechs compensate uh, the banks or NBFCs in case the borrowers defaults. So it is helpful to both parties. Uh, Expect Ugro to raise capital to meet its growth requirement next year. So there would be some QIP maybe in early next year for Ugro Capital. It's got an interesting shareholding pattern. 55.6% of the shareholding in the company is held by private equity players and DFIs, while share of domestic insurance company is at 4.7% and FPIs at 2.7%. Promoter shareholding of Mr. Sachindra Nath is low at 2.24%. So it can easily be acquired. Now, financial and valuation summary to see it is doing roughly around 300 crores net interest income this year. Uh, and It's showing an AUM growth of roughly 60%, 58% because of low base. NIMs are around 6.1, expected to grow to 7% plus. The cost to income ratio is coming down. The GNPA are expected to remain in this 3% plus category. ROA, return on asset, is expected to improve now to 3 to 3.6%. ROE is also expected to go up, and price to book, which is 1.7 now, is expected to come to around 1.2 as it grows to roughly around 700 crores of in FY26 of net interest income. Now, this is the expected revenue growth. So, if you see, the pace of growth was very high, but now it is declining because as the size will increase. But it is expected to have this Q2 FY24. It has had roughly 7,500 crores of AUM, which is expected to double in next 1 or 2 years. So, this is the kind of pace they are looking at. Uh, AUM mix is prime secured and prime unsecured, and that is why they faced a problem recently because of this RBI instructions on unsecured lending, and others are micro enterprise loan, supply chain financing, machinery loan, and partnership and alliances and other loans. And all. So it is this prime unsecured loan which was a concern. Now, comparing with peers, so if you see EPS, it's at lower level. If you see compared with MAS or and Five Star Finance, and the book value is roughly in FY25 is expected to be 195 rupees. Just keep this number in mind. ROA is expected to improve. ROE is expected to become better in line with its peers now. It is low right now. This is low because its equity base is low. So that is the reason, because most major investment is because of PE investment, and listed among the this thing, its price to book is expected to improve, uh, or has supposed to go down. So that makes it reasonable. Even the P, ROE, and EPS are expected to grow. AUM mix, as I had brought out, it is going to remain with this prime unsecured because this is the most attractive part, because the return on investment is the best. They are getting around 19% for unsecured, and secured is around 13%. Micro enterprise loans are around 20%, while supply chain financing is around 13% rate of interest, machinery loan 13, and partnership alliances they are giving around 14 at 14%. So they are adding branches. So they have prime branches, micro branches. So total they are reached around 104 in the second quarter of FY24. And no sector contributes greater than one-fourth of the AUM. So the AUM is divided under various heads. As I had brought out, they are lending to they selected MSME because of their uh, model. This is the AUM mix. AUM mix is expected to reach that 50% on book and 50% off book, where they are going to do a co-lending with NBFCs and banks. So then the loan would remain on the books of the bank. So the risk of the banks of the NBFCs is higher, and they are those fintech partners. So they make reasonable money on this. The shareholding pattern, as I had discussed, the promoter holding is low. This is a promoter holding 2.24%. Now, hence, this should be a concern. And in case they do a QIP now in next year, this will further dilute. So this is the only point. Hence, in case this they become very lucrative for acquisition. Okay, they have a large addressable market in MSME lending, and MSME lending IPO from Muthoot is starting next Monday also. Uh, Data analytics gives comfort on asset quality. They have a good software for data analytics. Uh, Expect an AUM earning CAGR of around 40 to 65% over FY24 to FY26, with ROA and ROE of 3.6% and 14.4%, better AUM per branch and per employee than its peers. It has software to score the customers. So they give scores as per the capability of customers, especially MSME, and expected to double or triple its revenue by FY24, by FY26 now from FY24. So to roughly around 19,000 crore. Uh, Present AUM is roughly around 7,500 crore. Uh, Target, as I brought out, is 50-50 on book and off books. AUM, uh, AUM mix. Now, if you see, as I showed you, the FY25 book value is around 195. So even if you give them twice, 2 times price to book, considering the growth, it should be reasonably trading at around 390, 400 rupees. Now, this was doing well, and after the last quarter results, but this RBI's loan restriction brought it down to 200 EMA, and from there it has bounced back. So watch out for these levels. These are the levels to get into this stock, because uh, in case their models are good and their NPAs are less, and they are able to control their lending pattern, because MS and there is a growth, because it's most important for the economy to grow, which is expected to grow. Then only the MSME also MSME sector also grows. So if the economy grows, then these MSMEs should do well. So expect this stock to do well over the next 1 or 2 years. If you get it at dips. I have finished. We'll take questions now.